Hello everyone and welcome back to these sessions on financial management. Friends, in this class of financial management, we are continuing with your interesting topic, that is dividend decisions. In earlier classes, we have covered up Gordon's model. In today's class, we are going to get started with Walter's model. So please write up this heading, Walter's model, in your notebooks and write up the description what I am showing over here. Don't bother about the understanding of formula and everything. We will definitely discuss this in detail, conceptually, along with the derivation. Let us move ahead and write further about Walter's model assumptions. The EPS remains constant from year to year. The dividend payout ratio remains constant. The dividend payout ratio can be from 0% to 100%. Now you should know one thing very well, the extreme possibilities of dividend payout ratio being 0 or that being 100% was not so applicable in Gordon's model. In Gordon's model, we have excluded those extreme possibilities of 0 and 100%, but Walter's model invites both of these also in its range. That means it is okay to give 0 dividend, it is okay to give 100% dividend. Walter's model will apply in all circumstances. Next assumption is the expected rate of return by shareholder can be less than or equal to or more than the rate of return generated by the company on its investment. That means we have learnt few possibilities with Gordon's model. One was R less than KE, one was R equal to KE, one was R greater than KE. All three possibilities are existing over here also. The capital of company will include equity share capital and retained earnings only. That means there is no chance of inclusion of any debt or any preference capital over here. So the capital is composed of only and only the equity share capital and retained earnings. Let us move ahead and take up some calculative examples, getting started with question number 7, a very important question. And because I want to highlight a lot of important issues over here, I have divided that question 7 into 3 segments, A, B and C. Let us focus on the first segment, that is question 7A. Here is the information given. So question 7A indicates rate of return on investment is 40% per annum. Rate of return expected by shareholders is 25% per annum. Expected earnings per share is rupees 20. Dividend payout ratio is 50%. Determine the present worth of share using Walter's model. And then it says, what will be your answer if the dividend payout ratio is reduced to 0 and then increased to 100%. So we will definitely answer that later part later. First we focus on the first line of requirement, that is determine the present worth of share using Walter's model. So what I am going to do for you is, I will be using Walter's formula, and after using Walter's formula, I will be substituting all the given values of variables into that formula and determine the value of equity share. While I do that, there may be no explanation involved, just calculation. Once you write up all those calculations, what I will do is explain you all the matters logically, giving clear derivation of the Walter's formula. It is something worth learning over here. So just let us first move ahead and note down the solution part. In your solution, of course, what you will first do is write up Walter's model formula, and when you write Walter's model formula, it is d by ke plus R by KE into E minus D whole upon KE. Now, this whole thing is so simple and logically understandable, but let us first do the calculation part. So, whenever you write a formula, of course, what you have to do is define all the variables. P0 is the present worth of equity share that we have to determine. D is the amount of dividend per share, that will be rupees 10. Why rupees 10? Because dividend payout ratio originally given in the question is 50% and earnings per share is rupees 20. So, dividend per share will be of course rupees 10, which is 50% of 20. Earning per share is rupees 20. I have already mentioned. KE, that is expected rate of return by equity shareholder, is 25%, which is also known as equity capitalization rate, and the rate of return on equity, that is small r used in the formula, which indicates company's capacity to generate the return on its equity, that is given as 40%. When we substitute all these values in the formula, what do we get is 10 divided by 0.25 plus in the numerator, in the second term, it will be 0.4 by 0.25 into within brackets 20 minus 10 and whole upon 0.25. When you apply this calculation, what you will get is 40 in the first term plus 1.6 into 10 divided by 0.25, that will be 40 plus 64, and finally it will be 104 as the value of share. This rupees 20 is basically earnings per share. Now please understand one thing, earnings per share is rupees 20 and this is shareholder of NJ Limited. So you tell me one thing, think and tell me, I am a company, earnings is not for me, earnings is for the shareholder. Therefore, if I am distributing any dividend out of this, it will go to whose pocket? It will go to shareholders' pocket. So, rupees 20 in our example is earnings per share and 50% is the dividend payout ratio. If 50% is dividend payout ratio, I am going to split this earnings into two components. One component, that is 150%, which is rupees 10, goes in the hands of the shareholder, take it shareholder, and another 10 is retained by the company. So please carefully understand, this 10 rupee is basically shareholders' money lying in the hands of shareholder, and this 10 rupee is also shareholders' money. It is not company's money, it is shareholders' money. It is also shareholders' money and lying in the hands of the company. So this is dividend and this is retained earnings. Now, if you could understand, when distribution of dividend did not happen, this was rupees 20 as E. E as a variable, I repeat, E as a variable indicates earnings per share. Out of that, rupees 10 is dividend, which is D, and what is remaining in my hand, in the company's hand, it is E minus D. So this E minus D is retained earning and this is dividend. Now, if you can visualize, shareholders' money in shareholders' hand and this is shareholders' money in the hands of company. What will be done with this money? Do you know? Both of these monies will be reinvested. Shareholders' money in his own hand will be reinvested by shareholder himself, and shareholders' money in company's hand will also be reinvested, but that reinvestment will be made by the company. Now the question arises, at what rate these monies will be reinvested? This 10 rupee will be reinvested at 25%. This 10 rupee will be reinvested at 25%. Why? Because that is the expected rate of return of this shareholder. This is KE. So shareholder will reinvest his money in his hand at what rate? The obvious answer is at his discounting rate. His discounting rate is 25% KE. On the other side, if company invests this money, Company will not reinvest this money at 25%. Company's return generating capacity is how much? It is 40%. If company's return generating capacity is 40%, company will reinvest this 10 rupees at a 40% reinvestment rate. Now, this money is shareholders' money in his own hands. For him, it is rupees 10 as it is. This is shareholders' money in company's hand. Now, please visualize this point very well. This 10 rupee will be reinvested by the company on behalf of the shareholder. This rupees 10 will be reinvested by the company at a return of 40%. This 10 rupee invested now will generate an income of rupees 4. I repeat, it will generate an income of rupees 4 in 1 year's time. If this 10 rupee can generate an income of rupees 4 in 1 year's time, that 4 is also whose income? It is shareholders' income, right? It is shareholders' income. If that rupees 4 is shareholders' income, think, for company to generate that rupees 4 of income, the company needs only rupees 10. And for the shareholder to generate an income of rupees 4, 10 rupee will not be sufficient. For shareholder, because shareholder's rate of return generating capacity is only 25%, for shareholder to generate an income of rupees 4, shareholder will require how much, do you know? Rupees 16. Now you would wonder, from where did I get 16? Simple common sense. Equity capitalization rate is 25%. When you divide 4 by 25%, you will get 16. Obvious thing, if he wants to generate income of rupees 4, he has to invest rupees 16. Then only he will earn 25% of that 16 as rupees 4. So the point is very clear. For the company to generate an income of rupees 4, company requires investment of rupees 10. For shareholder to generate income of rupees 4, shareholder requires an investment of rupees 16. Correct? So this 10 rupee which is in the shareholder's hand, it is worth 10 for him. But this 10 rupee which is in the hands of company is worth more for this shareholder. This is equivalent to rupees 16. That 10 rupee in shareholder's hand is 10 rupees. This 10 rupee in company's hand is equivalent to rupees 16 for the shareholder. If you people are understanding that this 10 remains 10, but this 10 is adjusted to 16. So as if this 10 and this 16 when clubbed again, the adjusted value of this money, will be 10 plus 16, that will be 26. Correct? That 26 basically is the adjusted EPS. Now, whose income is this? Shareholders' income. If this is shareholders' income with adjusted amount of that income as rupees 26, if 26 is earnings, earning capitalization rate is 25% for the shareholder, simply divide 26 by 25% and you will get your answer for Walter's model, that is rupees 104. Check it out. 26 divided by 25% will be your answer. So beta, if I just give you a recap of what logic we have tried to devise, it may take a couple of moments for you to exactly understand what is happening. So there is no harm in getting that point repeated. So once again, this is rupees 20 and company has decided that this rupees 20 that represents earnings per share, company is going to distribute 50% of this earnings by way of dividend. So this combined amount was E. E stands for earnings. 50% is dividend payout ratio. So 50% removed from this and given to the shareholder. This is the distribution of dividend by the company and this is the retained earnings. Symbolically, combined amount of these two was E and this amount is D. So this amount in the hands of company will be D minus E. Rupees 10 in the hands of shareholder is worth rupees 10, but rupees 10 in the hands of the company is worth much more for the shareholder. Now we have to find the real worth of this rupees 10. So think this way, company would reinvest this rupees 10 at 40% rate, and company's capacity is to generate 40% return on its investment. That means by investing this rupees 10, company can generate an income of rupees 4. However, shareholders' opportunity cost of capital is 25%. That indicates that shareholder, if he himself invests any money, he can generate only 25% out of that. So if this shareholder wants to generate rupees 4 as income, he will have to invest more value, he will have to invest something more than 10, and that capital that he should invest to earn rupees 4 with 25% rate of return, how much money does the shareholder require? The answer is 4 divided by 25%. 4 divided by 25% would be 16. So concluded that rupees 10, that is shareholders' money in company's hand, is as good as 16 rupees for the shareholder. So these two, both of these two, by face value it appears as rupees 10 at par, but real worth of these two is different. This 10 is 10, but this 10 is worth rupees 16. When you club these two values again, what will happen? 10 plus 16, the adjusted value would come to 26. And now use your simple concept. When you compute P0, it is adjusted earnings divided by K, because the expected rate of return is 25% of the shareholders. That means shareholders' expected rate of return is 25%. So if rupees 26 is representing 25%, what would be 100%? The answer is 26 divided by 25%, and that will be nothing but 104, which is the value of equity share as per Walter's model. So that was end of this drama. Now tell me one thing, could you understand anything out of what we have discussed? So beta, what happens when you understand something logically? Then I told you the formula that appears over here on screen, you can actually derive that formula, and I am going to definitely help you out on that. So as far as derivation of this formula is concerned, what you are going to do? Tell me what you are going to do. You are going to get started with that same logic that we have talked about, and I want you to first pay attention to this. We will relate all our logics with the Walter's model formula just in some time. So we started with EPS of rupees 20. Just try to recall that drama that I have played for you, where we started with rupees 20 as EPS. Do you remember that rupees 20 of EPS was divided into two segments? One was rupees 10, that was nothing but the dividend given to the shareholder, and another rupees 10 was retained earnings. Now what appears on the left is the shareholders' money in shareholders' hand, that is rupees 10, and what appears on right is shareholders' money in company's hand. Now rate of return on equity is 40%, whereas equity capitalization rate is 25%. What is the significance of these two lines? Companies having capacity to generate 40% return on its equity, whereas shareholders' expected rate of return is only and only 25%. So the amount of rupees 10 that is appearing on the right hand side, that is the right side, that 10 is shareholders' money in company's hand, which will be reinvested at 40% to generate rupees 4 as income. However, to generate rupees 4 as income, shareholder will require 25% rate of return. If considered, shareholder will require rupees 16 as investment value. That rupees 16 is the adjusted value of retained earnings. So this rupees 16 now clubbed again along with rupees 10, the adjusted value will be 10 plus 16, that is 26. If you divide this rupees 26 by 25%, you will get rupees 104, which is the value of equity share as per Walter's model. Alright friends, I am sure you would have understood that entire thing, and you would have also understood the logic behind calculating this 104. But let us now relate that logic with the formula so that we understand the derivation of the formula as well. Look at this variable D over here, D. This D indicates dividend. That means this will indicate that part of rupees 10 which is in the hands of shareholder, correct? Come to the other term over here. This is E minus T. E was rupees 20 and D was rupees 10. So E earnings minus D dividend. So within brackets what you will get is retained earnings, correct? So that retained earnings is also rupees 10 per share. Now do you notice after this bracket, outside this bracket, there is a ratio of R by K. This R by K indicates that R will be multiplied to retained earnings and then the result will be divided by K. So R is 40%. When 40% multiplied on retained earnings, you will get rupees 4, correct? Because 20 minus 10, retained earning is 10. 10 into R being 40%, 10 into 40% will give you 4, and that 4 divided by 25%, correct? Divide by K means divide by 25%. 4 divided by 25% will give you 16. So this is what? 10, and this adjusted value is 16. Each of these values when you divide by K, because these are the earnings for the shareholders, so 10 by K or 10 by 0.25 will give you 40, and this side, this term, it will be 16 by K, 16 by 0.25 will give you 64. So 40 plus 64, the overall value of share will be 104. So this is how the logic that we have discussed relates to this formula. This formula actually is the outcome of that logic. So I hope you are clear with this whole thing. If yes, then we can go ahead and deal with the later part of the question. Alright friends, so this was what we have done over here, logically derived that 104 instead of using a formula. But in examination you are not supposed to draw these kind of diagrams and make the calculation. You should always use the formula from examination viewpoint. In the question, they have given two other possibilities. One is if the dividend payout ratio is reduced to 0. So we again do one same thing. We substitute the values in the formula by now considering D as 0, because dividend payout ratio is 0, D will be 0. So E minus D will be 20 minus 0, and that will be 20. In other words, rupees 20 will be retained earnings and dividend will be 0. In that case, when you apply the formula and make the calculation, it will give you P0 equals to 128. Let me take you ahead and you may write up the other possibility, that is what will happen if dividend payout ratio is increased to 100%. So I told you there is no need to write the formula again and again, but for your reference I have displayed the formula over here on screen once again. We have to basically substitute the revised values in this formula, and when we do that, we find that entire earnings have been distributed by way of dividend. So E minus D, that represents retained earnings, will be 20 minus 20, that will be 0, and therefore anything multiplied to 0 is definitely going to be 0. So the second whole term will become 0, and the value of the share will be therefore 80 plus 0, and that is rupees 80. So you distribute more dividend, the value of the share is declining. You distribute less dividend, value of share is increasing. We are going to conclude this on a logical ground at little later stage, but first let us focus only on the calculation part. We will definitely discuss out the outcome of this and summarize that at the end. Let us move ahead and take the next calculative example given on question 7b. It is directly related with question 7a because it is asking you solve question 7a assuming the rate of return on investment is 25%. So in previous case we have seen that R was 40% and R was greater than KE. Now R is 25%, so R will be equal to KE. All other things in question 7a remains as it is. Just change one information, that is change R from 40% to 25% and observe what happens. And so let us see how to present the solution over here. We would write Walter's formula. I have already explained you the formula and its application. You must write the meaning of each of these variables along with their values. And can you notice one thing at the end stated over there? R is 25%, KE is also 25%. When you apply this whole thing, what you finally get is 40 plus 40, and that equals to 80. Let us move ahead and deal with the next possibility given in that same question, that is when dividend payout is reduced to 0. When you reduce the dividend payout to 0, all the earnings will be stated as retained earnings. And the wonderful thing that you will notice over here, because R is equal to KE, the adjustment factor that you are applying becomes 1. And when the adjustment factor applied is 1, you will actually see that the value of share still remains 80, even if the dividend payout ratio is reduced to 0. So please write up this part of the solution as well. Alright friends, I am sure you have finished writing this calculation. Let us now proceed ahead and see what would happen if the dividend payout is increased to 100%. You would see that here also the value of share would still remain 80. So while making these calculations, you would have already figured out an important conclusions in your mind, that when R is equal to KE, whatever be the dividend payout ratio by the company, the value of share will not change. It will remain same. That is rupees 80 in this case. Let me take you further and we take up the next part of this question 7, that is titled as question 7c. In this case again everything else remains same, but the rate of return on equity of the company or the rate of return on investment is 20%. So this time we are finding a possibility that R is less than KE. Formula remains same, but the value of R is going to change. R will be 20% this time. So obviously you are going to define all the variables, and finally when you substitute the value of each of these variables in the formula, because R is less than KE, your adjustment factor with retained earnings becomes less than 1, and this time you will see that the outcome is different from what we have seen earlier. P0 this time is 72. Let us now deal with what would happen if the dividend payout ratio is reduced to 0. This time, because R is less than KE, you reduce the dividend payout, and what will happen? The shareholders' wealth will further deteriorate. In other words, the shareholder will be worse off if you are paying less dividend, because company's own return generating capacity is weaker than shareholders' return generating capacity. So because R is less than KE, the value of share will reduce if you reduce the dividend payout ratio. Let us move ahead and look into what would happen if dividend payout is increased to 100%. So this time, because you are distributing more dividend, the value of the share will be definitely better than earlier. So in scenario where R is less than KE, you would find that the higher the dividend payout, the higher will be the value of the share. This time the value of the share goes to 80. Let us move ahead, and now what we do is we summarize from the observations from outcome of question 7a, 7b and 7c. Please carefully take note of this table, because here we have three different columns representing dividend payout ratio as 0, 50% and 100%, and in 7a, 7b and 7c the three situations that we have observed is R greater than KE, R equal to KE and R less than KE. When we put up the values in the table, we get 128, 104 and 80. In the next line we get 80, 80 and 80, and then 64, 72 and 80. If you notice one thing, when R is equal to KE, irrespective of the dividend payout ratio, the value of share remains same, 80, 80, 80. One more observation, when dividend payout ratio is 100%, value of share will remain 80, 80, 80, irrespective of relationship between R and KE. In the entire table, the highest value of share that we can find is rupees 128, and the lowest value of share that we can find is rupees 64. Observations from outcome of question 7a, 7b and 7c, and we now write up those conclusions that we have found. Number 1, when R equals to KE, the value of share remains same irrespective of dividend payout ratio. Second thing, when dividend payout ratio equals to 100%, the value of share remains same irrespective of relationship between R and KE. Third, when R is greater than KE, dividend payout ratio being 0, the value of share will be maximum. Correct? That is what we have found. In the table it was 128. Therefore, when R is greater than KE, the value can be maximized by setting the dividend payout ratio equal to 0. Last finding that we have is, when R is less than KE and dividend payout ratio is 0, the value of the share is the lowest, right? But we don't want the value of the share to be lowest. Therefore, when R is less than KE, value can be maximized by setting the dividend payout ratio equal to 100%. So this is the final conclusive summary of Walter's model.